This is just astounding for many reasons. Nice, clean United States government bonds. This is a representation. This shows you Hey everybody, welcome. My name is Matthew. Thank you again for joining. We're continuing on here with the 200-plus year series of the United States national debt. Looking at the most important components, that is the deficit, which is the percentage increase in debt every year. Taxes, how much taxes we actually have to pay down the debt, which we typically don't. We typically run surpluses. The interest rate, which is the cost of borrowing, the cost of the debt. And finally, the print, or how much money typically offsets the increase in national debt each year or each period from the central bank, from the Federal Reserve. Okay, so from this chart, all I can say is see prior videos for more detail on this. A lot of numbers. These are trailing 12-month percentages of the national debt to see how things shake out. Then we looked at this chart, which I believe puts it much better in perspective, looking at the deficit, the print, and the interest as a percentage of $1 of tax revenue, or cents on the dollar. For every dollar you receive in taxes, or the federal government receives in taxes from the populace, how much is the deficit, how much is the money print, how much is the interest rate at any one time. That brings us to what I promised before in prior videos, is finally this chart, which is simply the gross figures of the United States debt, which we've seen, plus the central bank ownership. All right, I'm going to take away this percentage. We'll come back to it. But how much government bonds, notes, and bills, that's long-term to short-term, in total, how many bonds does the Federal Reserve, the nation's central bank, own of the United States Treasury debt? And thus is the printing press. That is the brass tacks nominal value of how much money printing there is at any point in time. Okay, so let's go through it. Again, 19th century, we had two central banks in the United States, period. The first national bank of the U.S. ended in 1811, and then Andrew Jackson notoriously brought down the second bank of the United States, ending in 1836. Both of those were 20-year charters. They failed. I think many sound money people would argue rightfully shuttered. These were actually the second and third central banks in North America. There was, during colonial times, also the Bank of North America, which gave rise to the saying, not worth a continental. They had the continental currency, but in any event, that's a story for another time. There was no central bank during the second half of the 19th century and after the Civil War, and even during the Civil War. So the point of that is you can have debt without a central bank. Bottom line, you can have national debt without a central bank. National debt you can look at as the endogenous workings of the system. That is, Congress taxing, spending. If they don't have enough money for the spending, then they borrow from the populace. You can do all of that endogenously within the system, all right? But then if you want to sort of stealthily tax your citizenry, not with the direct taxes, you money print, okay? And this is nothing new to the United States. This is done throughout the sovereigns, throughout the centuries, but that's the brass tacks, that's the point. And so this is the taxation without representation point of view. Now, I want to try to be quick here. This is not the only video we're going to show of this. I've showed this video before anyway. Longtime listeners and viewers will be familiar with this, but the point is, this is the money print, okay? So this is, in economics, we call this outside money. Now, one really quick point to note is this is the asset side of the Federal Reserve's balance sheet. Okay, so this is actually how many treasury bonds they own. The liability side is actually the money. That's actually the outside money, the money that they create from nothing to buy the bonds. Okay, and the point is that it mirrors these values, okay? So if you looked at a picture of the Federal Reserve's balance sheet, it would look very similar to this. It wouldn't look exactly like this because they have a few different ways that they print the money. There's paper currency, and then there's bank reserves. There's also this new reverse repo facility, relatively new, which they've really exploded since COVID for non-banks. The point is, with all of those tools, all of those monetary instruments, all of that outside money, which is the liability side of their balance sheet, they buy the bonds, all right? And here I want to reference, we'll watch a quick clip of this video. This is very popular in sound money circles. Clip from Finding the Money. This is Jared Bernstein trying to explain how they print the money and buy the bonds.
Like you said, they print the dollar. So why does the government even borrow? Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Because they sell bonds and people buy the bonds and lend them the money. Yeah. So a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to I guess I can't really talk. I don't get it. I don't know what they're talking about.
Okay, so obviously this is just astounding for many reasons, and many people that are familiar with sound money. Firstly, this is an economic advisor to the president. He doesn't know the mechanics of money printing. He doesn't know how money printing actually works. Secondly, he confuses the definitions of lending and borrowing between the federal government and the central bank, and he just doesn't seem to know the relationship offhand. Print the money to sell the bonds, print the money to buy the bonds. He's not quite sure. Brass tacks. This is a representation. This shows you the money print, okay? So we have this much debt, the same picture that we've had for a long time, showing you 200 plus years of United States debt. And as the Federal Reserve grows in importance, which really it did not have a huge proportion. You can just see, look at the green shaded area. That's the Federal Reserve's portion of bonds. It was not huge. Okay, let's just look just at the Vietnam War as interest rates were soaring to 20%. This was actually a relatively larger percentage, which I'll show you in a second. The federal government debt was $700 billion. The Federal Reserve's portion was $100 billion. Okay, so 1/7, not trivial. But way back in the day, you know, during the Great Depression even, the federal government had $40 billion and the Federal Reserve had, say, $2 billion. Much smaller percentage. But then as we get to the global financial crisis, you see just the odd nature of the Federal Reserve's balance sheet. Let's zoom in. It looks just very bumpy, lumpy, and much bigger than it ever had been in the past. And then you get to COVID, and of course it explodes even more. All right, so let's show you, as I started with this video, let's show you a percentage of the government paper that is actually owned by the central bank. And how does the central bank own it? They print money to buy the bonds. There it is. All right. First thing you should notice is that the Federal Reserve, as they like to say, was just practicing pre-Great Depression, okay? And the lending, this is a separate video, separate topic, but the lending that the Federal Reserve was doing, in other words, the buying of bonds that the Federal Reserve was doing, was not in the government sector, okay? Before the Great Depression, very small percentage, right? As I alluded to before, 1%, 0.4%, very, very small, 3%, okay? We still had a Great Depression. But what was the Federal Reserve doing here? It was lending its balance sheet, not to the government, but to banks, to companies and to banks. Okay, so it was in a completely different game than it is now, lending at the discount rate. Post-Great Depression was the first major print. You see it spiked to about 10% ownership of government bonds, but then fell back down again, 5%, below 5%, back to 3% on the eve of the United States entry into World War II. Most of the gold was also flowing into the United States at this time to get away from Stalin and Hitler and tyranny. So that was a benefit to the United States. Bretton Woods, they had the gold, the dollar reserve standard, where central banks around the world reserved dollars. The United States itself reserved gold regardless. It didn't help the United States because when the Vietnam War started, they had to borrow more and more and more directly from the Federal Reserve. When I say borrow more and more from the Federal Reserve, that's a unique entity, okay? It's not unique if the United States spends more than it taxes and it just goes to the populace. It goes to Wall Street, it goes to Main Street, it goes to investors, it goes even to foreign investors. Say, look, we're going to run some deficits here. We're going to issue some more debt. It's going to pay this interest rate. It's going to pay this yield. Buy that debt. You can see that they had a problem with this. And this was indeed why the gold standard collapsed, is because of the Vietnam War. They started borrowing more and more and more from the central bank. The French said, look, we don't trust the value of your dollar anymore. You're just money printing to make up the deficits, i.e. the accumulation of debt. We want our gold back. And that's what brought the end of the gold standard down, Charles de Gaulle. All right, so after, notice this peak here, right during the end of the Vietnam War. As the Vietnam War concluded, it was the peak craziness of Federal Reserve printing to buy United States government bonds. 15%, all-time high, all right? During the then 60-year history of the Federal Reserve, that was an all-time high. And as we know, prior videos, Paul Volcker, very good gold bug actually, Federal Reserve chairman, had to stymie all of this inflation because there was what they called stagflation at this time, high unemployment, high inflation rates. He took interest rates to 15% to prick the inflation bubble. He also pricked the gold bubble, which happened at the same time. Gold was at over $800 an ounce for about 2 seconds. And then we eventually see a return to normalcy, quote unquote normalcy, where the Federal Reserve owned a smaller and smaller proportion of the United States debt. Now, look, I'm not saying, again, I'm just trying to quote and show you reality. My own feelings about money printing, about sound money, about issuing more debt than you can handle are obviously on the conservative side. Talked about that a lot, but we just need to look at what's happening to understand what might happen next. Okay, so we got down in the 90s to only 7%, right? Really low levels. We hadn't seen those levels since the 50s, since World War II, that we saw in the 90s, which is a good level. The Federal Reserve was only printing 7% of the United States debt. And no, this is balance sheet. To understand the difference in accounting here, balance sheet is at any given point. It's a snapshot at any given point, and I'm showing you over time how much of the federal debt they owned. Here, in the prior two charts, these were flows. These were a period of trailing 12 months. Okay, just want to remind you, this is balance sheet. This is brass tacks. This is how it looks at the end of the day. Okay, so this will give you a really full, rock solid picture of how much money is actually being printed at any given time to buy United States government treasuries. In other words, to set a floor on the price of United States government treasuries, because had the Federal Reserve not been there, it's very possible the price would have been lower, interest rates would have been even higher. So everything seems okay. Congress, even in the divided Clinton years, divided Congress, divided government with a Newt Gingrich Republican-controlled Congress and a Democratic executive branch, they balanced the budget unbelievably by the end of the 1990s, start of 2000s, start of the Bush years. There were a couple periods of a balanced budget. We've talked about that. Interestingly, the money print was rising a little bit here. So to balance the budget, they actually had to print a little bit of money. That's important to keep in mind. And but it was balanced. It means they spent the same amount, even they spent a little bit less than they took in taxes over any rolling trailing 12-month period. Okay, so it was balanced budget. Everything seemed okay, but then of course we had the 9/11, Iraq War, Bush years, neocons, some trouble, and then of course Bush with his profligate spending as well. Notice the debt. Look at the debt levels here. The bank icon, you see it increasing at a quite fast clip here in the 2000s. Of course, when he left, we had the global financial crisis. This little drop here, let's just zoom in. There's a little drop, you notice, of the Federal Reserve's ownership of government debt. This is as they were working out these TARP and TALF and fiscal measures, basically the bailout of Wall Street. So the Federal Reserve took on corporate debt on its books for a time being, then had to figure out how to work this out. And they figured out, okay, let's give all the bad debt to Fannie, Freddie, Ginnie, government guarantee it. Federal Reserve will take that debt on its books, and let's just give Wall Street nice, clean United States government bonds. So that's what they did. They were working out these sort of swap arrangements, and then QE1, 2, and 3. This is where they were buying trillions of dollars of mortgage-backed securities, bad debt from banks, from brokers, from money market funds, QE1, QE2, QE3. You'll see that at the end of QE3, end of 2014, start of 2015, this is an all-time high of the money print relative to the United States national debt. This is brass tacks. All right, this is what Jared Bernstein needs to watch to understand. This is the core of the monetary printing press. This is what it represents. This is what it does. They print money to buy government debt. They set a floor on the price of bonds. And 23.3% was a record by the mid-2010s, by the end of 2014, start of 2015. I also have always hastened to say that if you're a sound money, hard money, Bitcoiner, gold bug, whatever, you got to understand when you're talking about when they're printing, when they're not printing, okay? Because from this period, which is when a lot of Bitcoiners, hard money Bitcoiners started to come online, they were saying all the government does is print money. All the central bank does is print money. Keep in mind, government doesn't print money. The central bank prints money. All the central bank does is print money, print. That wasn't happening from 2015. Notice what happened at the end of QE3. They tried to go through this process of balance sheet normalization, all right? So they went from owning 23%, a quarter of the government debt. The Federal Reserve went from owning a quarter all the way to the eve of COVID of owning 15%. Okay, and then if you look closely, this is actually the interesting rub, because we see things explode again during COVID. What happened during COVID? Well, again, more stimulus, more bailouts, more free rides, more money printing. We see that here. This is another, it's definite QE. They tried to actually not call it QE this time, which is nonsense. They printed money to buy bonds, and they took a larger proportion of the United States government's balance sheet. That's what happened. But look here, right here. You see this, how it was going down, normalizing the balance sheet. And then in September of 2019, it stops and it starts to go up. There's more money printing relative to the federal government's total debt until March 2020. It explodes, but it's creeping back up here. What happened here? The repo crisis. Repo rates spiked, overnight rates spiked between banks and lenders, hedge funds, so on and so forth, where the world was seemingly awash with liquidity, because it's still 15. Notice the 15%, even though it's coming down, 15% is way more than it was, in the 90s. So the world seemed to be awash with liquidity, but actually the world wasn't. The Wall Street, main economic banking powerhouse world, they didn't trust each other with their reserves. They didn't trust each other to lend out their reserves. And so repo rates, which are a signal of this, just flash spiked overnight, and the Federal Reserve had to intervene. They had to provide more liquidity, which what they're doing here, they're providing more liquidity. It's a sign of a fragile system. Every time the Federal Reserve is doing this, it's a sign of a fragile system. They can do it in the name of a crisis, but more importantly, it's a sign of a fragile system, and it often happens, or let's say it can happen, precipitating the crisis. It's a signal that precipitates the problem. So even though we had a worldwide pandemic here, which fully kicked off in March of 2020, although we know it was going on in countries that weren't telling the rest of the world already in 2019 summer, this was very interesting in that they were printing money even more from September 2019. All right, so something to keep in mind here. And then, of course, it explodes. Massive amount of money printing to the point where we got peak COVID. October, let's stop at October, for example, March 2022. March 2022, the Federal Reserve owned 27.9% of the United States federal. That means, literally, via monopoly, 27.9% of the United States Treasury bonds that are issued are bought via money printing. Actually higher, to be honest, because I'm not showing foreign creditors, i.e. big central banks abroad like the BOJ, ECB, and PBOC. They also were doing their own money printing to buy government bonds, which is another story. It's another story. It's part of the puzzle, but it's another story. But if you just look at the Federal Reserve itself, its own exogenous money printing, it's outside money that it's adding to a circular closed system that is the dollar, that is the United States Treasury and the United States managed economy, is at an all-time high here, peak COVID, 28%. And then they try to do it again. They realize they went out of control. Price inflation is peaking here. And so they try to normalize the economy. Let's zoom in. We get all the way here. We even get to, let's go to March 2023. What happened here? SVB and many other banking crises in the United States, the Silicon Valley crises. There's a lot of implicit guarantees that they made at this point, but they did not do major money printing. There was a little bit of an uptick in the Federal Reserve's money printing here, but it was not reflected in the overall debt. It's more a soft backing. It's guarantees more than actual buying of United States government bonds and bailing out different members of Main Street or Wall Street. Regardless, the Federal Reserve is on this path. And what happens when they own less and less of the United States government debt? What happens? Interest rates rise. So that's why you're seeing interest rates rise, and why they have been over the last couple of years is because they are the main monopolistic economic actor in the system, is restricting the flow of money that goes into U.S. government bonds. That's the main faucet. That's the main tap that how this exogenous outside money gets into the system. When the Federal Reserve allows United States Treasury bonds, notes, and bills to roll off its books, or simply sells them back into the market, which means that they'll take reserve balances from banks, give them the Treasury bonds, they're removing that outside money from the system. Okay, so that's how this fiat monetary system works. Supposedly perfected by these technocrats over the last 100 years, the swings look pretty wild, okay? And so down and down we go to where, as of last month, indications it's going to be down on the same trend. For next month, the Federal Reserve is still holding tight. They are still keeping monetary policy tight. So this is the brass tacks of what it means when you are keeping monetary policy tight, and they're trying to rein in all of the inflation that they caused in these prior years. But the important thing to keep in mind here is that this is the balance sheet. This is the overall view at any one given point in time of how much the federal government has intervened in the United States Treasury market, right? And what the main takeaway is QE1, QE2, QE3 took us to all-time highs. COVID took us to another just huge high, over a quarter, nearly 30%, nearly 30 cents of every dollar of debt issued by the United States. And what is debt? As we talked about in all the prior videos, it's simply the accumulation of deficits. It's the accumulation of those spending periods more than they tax. So 30 cents on the dollar of every single piece of debt, every treasury bond, note, and bill that the United States government offered to the market was printed, all right? And that's what they're trying to rein in. But if you just look at how during the Vietnam War, it's more jaggedy. It's at least some sort of a market sentiment. You can see that the Federal Reserve is clearly intervening massively as the Vietnam War drags on and draws to a close. But you see how it goes up and down, up and down. Here, it's the lines become smooth. The Federal Reserve is trying to make it predictable, trying to tell the market, we're going to be removing $10 billion this week, $20 billion next week, whatever. They're trying to be transparent and smooth to the market, but the overall effect is anything but. You never quite know what might happen. And even if you look in September 2019, this is pre-COVID. This is pre-explosion of COVID. You never know when they're going to turn the monetary spigot back on. We're going to continue on this in future videos, but the point is we are still close to all-time highs today. 20% of the United States government debt is owned by the Federal Reserve. That means that 20% of the United States federal government's debt is printed monopolistically by the central bank. What does that mean? Can that last? Where are we in the cycle? Where are we in the trend? That's what I'm going to talk about in the next video. Thank you very much for watching.